Hi, it's Friday, July 29th for the Rant. I'm getting happier every day. Finally, the Federal Reserve and central banks have cooked their own goose. You got to kind of think about how we got here. Just remember, we had the 2007 to 8 crash. It was the worst since the Great Depression, but nowhere near the crash and the unemployment, but the worst we've seen for a long time. And central banks just overreacted and started printing money like crazy. I mean, it just started in 2009 with a big jolt, and then more and more, and then they just plat out more, and then just more and more. And then of course with COVID, they went crazy. This is the key point here. Ever since 2009, the bottom of that recession and the printing to bring us out of it, central banks have decided we can't have a recession. The economy's too fragile. We're too much in debt. So we're going to prevent this recession at all costs. And so what really happened here was when COVID hit, they overdid it. They panicked. They printed, and I've reminded subscribers many times, $5 trillion in fiscal and 5.1 in monetary. $10 trillion they printed in just 2 years because they were concerned the COVID crisis, which by nature was only short term. Okay, it was only short term. Why would you do this? They know how weak the economy is because they've been stimulating it for 13 years, and it always takes more. It's never enough. The assumption, you have to remember, the assumption from the beginning was, this is just a financial crisis, a little too much borrowing debt, and if we just kind of stimulate a little bit, we'll come back and go back to normal. No, there is no normal when our spending wave is turning down for 13 years, and now we're at the bottom of it, the worst part. This is the weakest the economy is going to be demographically in our lifetimes, okay? So that was the assumption. Well, it didn't work out that way. So now they overprint, and guess what you get? Finally, the economy's helping it. 9.1% inflation in May. I think it does look like inflation is peaking now if you really look at everything, but 9 to 10% range. That came out of nowhere. And my inflation indicator, the best one to indicate what fundamental inflation would be from workforce growth, which is the biggest cause, says we should be at 1.5%. So this is where they blew it. They overreacted to COVID, so they're constant like, okay, we'll just keep stimulating, just keep this thing barely going. It broke because now the inflation forces them to tighten. And the articles I read now say, look, even though the economy's already showing signs of slowing, and leading indicators are definitely showing that, inflation is going to be stubborn at first, and they're going to have to keep going a little longer than they would like to. And my view, as you know, is, hey, this economy is weak. So it's going to crack hard from this tightening. And now the evidence is into me. This first crash took a little longer than I would like by past comparisons of first crashes. But it's been down 35% for the NASDAQ recently, 24% for the S&P 500. That qualifies enough for a first crash. And we have to remember, everything's going to be different this time because the stimulus and the high government intervention. And so it looks like that first wave was completed on June 14th, and we're in that second wave bounce up. Now, I would prefer to see this be on the weak side. That's even more sign. But the big sign we all have to look for, the final confirmation. I mean, again, I'm 95, 98% now. That was a top on January 4th, and we're going to go into the biggest crash in our lifetime. But the next sign and final sign would be we bounce here, and then we come back down and break to a new low over June 14th in the indexes and head down again. That would be the third wave down. You got to remember, 1, 2, 3, 4, 5. Is how a major crash or a major bull market happens. And so that would be the third wave down, which tends to be the strongest and should be at least as much as the first wave down. So once we go to a new low and break through that, it's going to be, okay, that next wave will prove this is not an ordinary correction. And first of all, it's already been more than past corrections. But this could still be a correction at this point, okay? this will prove, no, this is not a correction. We are going into a deep crash. So that's what I'm going to be looking for. How high does this bounce go? It's looked very tepid except for one day. And again, I like that. But this bounce should last a month and maybe two, okay, something like that. And then we would set up for another 5.5 month wave down minimum, and as strong or stronger than this first wave. And that's going to take us into deep territory. So folks, for the doubters or people say, well, I took some off the table and then sell into this bounce. This is the last chance. And boy, if it breaks those lows in June 14th, when it comes back down again, then whatever reservations you have left should be pretty much gone. We're into the greatest crash of our lifetimes. And remember my downside targets: 86% on the S&P 500, 92% on the NASDAQ, okay? Bitcoin to as low as 3,250, 3,250. This is not something to sit through. Tell all your friends.